Portfolio Builder is now outperforming the S&P 500 2,356% since inception. And in 2023, it's beating the S&P 500 by 237%. Buy these stocks now to get rich ahead of the 2024 market cycle. Here's a look at our high-risk portfolio allocation currently. Each unit of investments coming in at $3,944. And to build out a unit, you have 42 shares of UVXY, the stock crash insurance. We've got 98 shares of treasuries, the long end of the bond market. So it's the TLT times 3 with ticker TMF. That's the defensive side of the portfolio. And about 3.7% is in the crash insurance and 18.6% in the deflation or slowing growth camp with the bond market. On the offensive side, we've got 17 shares of Coinbase playing digital currencies. This position is taking a little bit of a seat in the back due to the wells notice by the SEC, but as soon as that's cleared up, I think it's going to rocket higher. We've brought in the bulk of our gains this year with FNGU up something like 200% this year, the single highest returning ETF that is in there. So we've made a lot of money on that. Obviously, it's the big tech companies times 3 playing the AI revolution happening right now. And then we're hedging against a return of inflation with the big oil and gas companies times 3, ticker NRGU. So you've got 17 shares of Coin, 14 shares of FNGU, and 1 share of NRGU. Now, if you're in the membership area, you can calculate how many shares to buy for any amount of money just by typing it in up above and hitting calculate. So again, everybody has the exact same ratio, so we get the same returns over time. Currently, we're up 26% year to date with a 6.5% return in May. Our safe growth portfolio has been betting primarily on bonds, and bonds keep getting hit with strong labor data and sticky inflation. We believe that's all about to turn around towards the next several months and push bonds much higher. So we're not making any changes anytime soon. The safe growth strategy has a unit cost of $19.07 with 19 shares of UVXY, 114 shares of TMF, and then we're playing the value play with EDC, that's emerging markets, EEM times 3 with 12 shares. We've got the Grayscale Trust GBTC to play BTC with 22 shares. That's our best performing play in that portfolio this year. And then we're long NRGU if inflation comes roaring back with, again, 1 share of NRGU. This portfolio is taking a bit of a beating this month, down 13%, but we still think treasuries are the single safest play over the next year and a half to double, if not triple your money. So no plans to change that out anytime soon. If you want to learn more about our products and services, call Dean at 505-322-7515. Okay, so here's some critical charts before we look, some critical economic data before we look at charts, and then we can go into Q&A. Essentially, Bank of America is predicting we're about to have inflation fall pretty rapidly for the next few months and continue to decline all the way into next year, pushing the inflation towards 3%. And we do believe that's the case. Typically, when the Fed stops hiking interest rates, that's peak yields. So the market believes the Fed will pause currently in June, but the probabilities keep creeping up. We've gone from 15% a week ago to 34% today. If they are about to stop raising rates, we're likely going to see interest rates flatline and then fall, which will bring up the valuation of stocks and digital currencies so long as the economy doesn't crater, which at this point we don't think that's the case. Here we can see today the probability has jumped to 37.9 yesterday, 35 right now, as far as the probabilities of a rate hike, which means it's not going to happen. Now, we're a few weeks out. I think the only thing that would push that over the edge would be the CPI report coming out the day before the June meeting. So June 13th, we get CPI, June 14th, the next interest rate decision. Here's a look at the long bond over time, and you can see the trend is lower and lower and lower. We've gone way out of the trend. We're expecting this to crash probably to a new low sometime between 2025 and 2030. We could probably see rates hit towards 0 especially with AI coming in and destroying hundreds of millions of jobs temporarily. Typically, new technology destroys jobs, but then creates a job growth, and overall is very good for the economy. If we look at the M2 supply, it's predicting inflation will fall till mid 2023. And we can see PPI is also driving that inflation print lower. So we do believe that the CPI print will be in our favor and that the Fed will pause, that peak interest rates are here, and it's a very good time to be long tech or digital currencies. One factor in the CPI that's not showing up yet is that rent growth has gone flat and may go negative. This is not showing up in the CPI data yet as they look at data a year old, which is mind-boggling that they would still do that. But we know for sure about a third of the CPI component is going to start to fall towards zero, which should really help drive that inflation data down. Here we're looking at PPI versus CPI. And again, this is predicting in several months that the CPI is going to fall from 5 all the way down to 3. And again, that would be very good for bonds and stocks. Now, there's big fear that the government's going to run out of money. Looks like they're not. They're going to get to about June 15th, where a ton of money comes in from corporations. So we're really looking at August. So there's still several months for the debt ceiling negotiations to work their way out. That's why we're not getting super scared running for the hills when it seems pretty far off from a deal occurring. Now, this is looking at returns of stocks around government shutdowns, and you can see for the most part, stocks end up going up regardless in 3 out of 4 examples. Only on the gray example did we have a bit of a sell-off, but we still ended the year flat 100 days later. So we're not freaking out over the debt ceiling at this point. Here's a look at the 2-year bond. Hit a peak of 5, it's been trading sideways. It's been going back up, which is driving that probability of a rate hike higher. But this would have to go significantly higher for us to get the probabilities above 50%. Here's a look at TMF. You can see it had a nice return to start out the year, pulled back, jumped back up, pulled back. But we think this could double, if not triple, in the next year and a half, and plan to continue playing this TMF ticker. Here's the dollar index, which has been rising again back to 103. We think over a decade this could touch 90, and that'll be when you want to take a big profit on tech companies and digital currencies, because that's, again, where we think interest rates will bottom out in 5 to 10 years at new lows. Here's a look at the yield curve, highly inverted, so you're getting paid more on the front end on the short duration debt than the long end, and this is being manipulated to do such by jacking the federal funds rate up higher. So we believe, again, they're going to top and then have to cut, and that interest rates are basically peaking out right now. Here's FNGU, our best play in the high risk portfolio, up 204%. And again, it could go a lot higher. These stocks like Microsoft and Amazon and Tesla, NVIDIA are nowhere near their all-time highs. And they're doing very well in a high interest rate environment. As those interest rates fall, the valuations of tech stocks go skyrocketing up. Same is true for Coinbase. Again, it's being held back due to the SEC's Wells notice. We do think this will reach new highs this cycle as well. So continue to plan holding this. In the safe growth portfolio, we're long GBTC. The parent company of Grayscale seems to be in big trouble. So we may look at an alternative for this. But for now, it's been performing well, up 71%, the top performing asset in our safe growth portfolio. EDC was doing great when everyone thought the inflation was done. And you can see it started off the year very hot, but then inflation and labor data kept coming back and the bond market sold off. So EDC is going to do very well when interest rates are falling and the dollar is falling, which is going to happen when inflation is falling. So I think EDC is getting ready for a rip higher. No plans to change that. A good barometer of inflation is oil, and our favorite inflation hedge is to be long oil and gas companies. And so for this year, we've seen oil primarily fall from the high of the around February when Russia invaded Ukraine. It's been pretty much just going down since then. So not freaking out about that. NRG has been trading sideways for over a year. But we do think as soon as the Fed stops hiking interest rates and interest rates start to fall, the economy is going to reheat, and that NRGU could break back towards the 600 to 900 range. So we're waiting to get more aggressive on that as soon as we see interest rates really start to fall, which will give more capital to the world and most likely turn the inflation problems back on. Here's another look at that 30-year bond, way out of trend. We love bonds over a 1 to 2 year outlook, and we do see this breaking to new lows over a longer period of 5 to 10 years. Gold we're not playing, but keeping a look on it. Very bullish chart. Could it break to new highs? We will see. And a similar on silver. Again, not playing these two assets currently. We prefer the digital currencies, but added that to the slide deck. Now, UVXY keeps getting smashed. There's big players in the market buying 0-day options. That's keeping the market afloat and just killing the volatility. So at some point, we'll reload up on UVXY. I just don't think the time is just yet. Maybe next week we could add a little bit to it, or in the coming weeks if this debt ceiling problem isn't resolved. Now, funny enough, when the debt ceiling is resolved, might actually be a better time to buy a volatility hedge, because Janet Yellen's going to issue around $1 trillion of debt, and that could jack interest rates up for a short period of time. Here's the banking ticker, KRE, the regional banks. This seems to have stabilized. But again, once that debt ceiling is lifted and $1 trillion of debt is pushed into the system, if the money's coming from money markets and reverse repo, the banking system will be fine. And it's probably be very bullish for markets because they're going to see $1 trillion of funding that's going to soon enter markets, and the markets may front run that. However, if the money comes out of banks and everybody stays put in their money market fund because they don't want to buy bonds yet, this could collapse more regional banks and create more volatility in markets. So it's very important inflation goes down if we want to see money market funds and reverse repo go out of those products and into T-bills and notes and bonds. So where the money comes from to fund the governments would be very important. And again, inflation expectations are going to be what drives that. Here's a look at the key indexes. The S&P 500 up 7.8%, 7.8% this year. The NASDAQ killing it, up 25%. IWM only up 0.9. So the reality is a few tech stocks are driving the whole market higher. And until inflation starts to fall, most likely we need to be cautious. So call Dean now to learn more about our products. I don't see us making any major changes. We may start to slowly add to the UVXY every week over the next several months in very small increments if we don't see this debt ceiling problem resolved, or if the inflation print next month comes in hot, or if the labor market looks way too hot. So any signs of inflation coming back with vengeance will cause us to want to get more defensive. Okay, very good. So I'm going to go back to the current trade alert for high risk and go over any questions. At this point, I don't see any reason to make sudden changes to the portfolio. Okay, very good, guys. So any questions today? I know it's a pretty quick presentation. We're really in a waiting game for the inflation to crash, see our bonds take off, take some profits, and then roll into NRGU and UVXY. That's really what I see coming down the pipeline. So again, we want to see inflation break to the downside, see interest rates fall rapidly, see the CPI fall rapidly. We're going to expect to pick up some big profits on our tech companies and our bonds, take those profits, and then get ready for inflation to come back because money's become cheap. The excitement of everything's going to drive more speculation into oil, and then that's when we're thinking NRGU is going to do well. So make money on tech and bonds first, and then roll those profits into oil and gas, expecting inflation to come back as soon as everyone gets excited, overly excited that inflation's finally broken to the downside and that interest rates are falling. So Kent says we all got to just stay steady and stay the course. Yeah, so that's the plan. The inflation's been falling slower than everybody would hope, but it has been falling, and there's really no reason to believe it won't continue to. In fact, the next few prints could be very bullish for us in the way we're positioned. So we will be back with a Rebel Dividends webinar next Tuesday and Dividend on Monday. If you're a paid member, we're We're stopping all investments after June 30th. So call Dean to learn more about that. The reason why is because we are switching from 506B to 506C, which means only accredited investors after June 30th for Rebel dividends. And if you're not a paid member, you want to learn more about our newsletter, call Dean at 505-322-7515 for that as well. But Monday, we do the weekly dividend for Rebel Dividends investors, where you get exposure to digital currencies with leverage. And it's really neat. We're able to borrow against that and funnel dividends through, which is a much more cost-efficient way to take profits while we don't sell or realize gains on the digital currency. So it's really a brilliant product. There's nothing like it in that regards. Next Wednesday, we'll have our next Portfolio Builder newsletter update. And we're just going to really stay course for the next several weeks. So we've got about 3 more weeks to wait to see how the CPI comes out on June 13th and then June 14th. Hopefully we'll get the Fed finally pausing. Market's going to really like the official pause because that means interest rates are likely topped out. If interest rates fall, the valuation of tech stocks and digital currencies specifically skyrockets up as interest rates go down. Okay, very good, guys. Well, we're keeping it short and to the point. There's no changes, so we're not going to waste a whole lot of your time. Thank you so much for joining us live, and we'll see you back next week, same place, same time.